Hello, my name is Heaven Scott, and this is my presentation on tax deductions for homeowners. So the discussion topics of this presentation is going to be mortgage interest, property taxes, Tax Cuts and Jobs Act, as well as state and local tax. Owning a home comes with many financial responsibilities, but it also offers certain tax benefits in the form of deductions. One of the most common tax deductions for homeowners is the deduction of mortgage interest, which allows homeowners to reduce their taxable income by the amount of mortgage interest paid. Taxable income can be lowered through the itemized deduction mortgage interest. Mortgage interest that was paid during the tax year can be deducted from the first $750,000 of the mortgage debt. Houses bought before December 16, 2017 can deduct interest on the first $1 million of the mortgage, but $500,000 if you're married filing separately. So what qualifies as a mortgage interest? Houses, apartments, condos, mobile homes, and even houseboats qualify as a mortgage interest, but there are requirements that have to be met, such as the home must have sleeping, cooking, as well as toilet facilities. If the homeowner has a non-taxable housing allowance from the military or the ministry, they can still deduct home mortgage interest. Another tax deduction available to homeowners is property taxes paid. This deduction particularly is beneficial in areas with higher property taxes. Property tax is a levy on certain types of physical property such as homes, real estate, as well as land. Local and state governments collect property taxes to fund school districts, police and fire departments, road construction, and other local services. The home's value is typically multiplied by the established property tax to determine the property tax rate, which I provided that right below. Homeowners can deduct up to $10,000 and $5,000 if married filing separately for a combination of property taxes and either state and local income taxes or sales taxes. You'll need to itemize your taxes instead of taking the standard deduction if you want to deduct property tax. And the last thing we're going to talk about is the Tax Cuts and Jobs Act, as well as state and local tax. So the Tax Cuts and Jobs Act changed individual income by lowering the mortgage deduction limit, and as well as putting a limit on how much you can subtract from your taxable income. As of December 22, 2017, the state and local taxes created a new limit on the amount that can be deducted on a tax return. So the itemized deduction will be capped at $10,000 for single taxpayers, head of household, as well as married tax filings jointly. The cap is $5,000 for married taxpayers filing separately. And that is the end of my presentation. Thank you.